Silicon Valley Bank collapses and second biggest U.S. bank failure ever. This is an independent story. California-based Silicon Valley Bank was seized by regulators on Friday, making it the second biggest bank failure in U.S. history since 2008 collapse of WAMU, which had $307 billion in assets when it was shuttered on 25th of September 2008, 10 days after Lehman Brothers failed. Silicon Valley Bank failed after depositors, mostly technology workers and venture capital-backed companies, started withdrawing their money, creating a run on the bank. The bank had approximately $209 billion in total assets and about $175 billion in total deposits. As of 31st December of 2022, this is Silicon Valley Bank. And it was unclear how many of its deposits were above $250,000 insured limit guaranteed by FDIC.
93%.
However, 93%, right. However, there is little chance of contagion in the banking sector as major banks have sufficient capital to avoid a similar situation. So this has scared a lot of people. I'll go to you first, Barry. Based on what we know, what was your reaction? Were you surprised? And then we'll get into how we feel about the way they're handling it, whether it's Yellen, Biden, because he gave a speech today.
So, okay, there's a lot to unpack here, so I'll just try and be quick here. So this bank had problems because in 2008, under the Dodd-Frank, they were allowed to invest in assets. Now, it wasn't a bad decision necessarily to invest in these assets, but what happened was that they were yielding on $82 billion worth of investments around 2%. Now, it's okay because if you're paying your depositors very little, you can make some spread there. But as you know, when somebody deposits money in your bank, you don't have all those assets on hand. You keep roughly 10%. The rest you lend out to try and make the arbitrage, to try and make the spread. That's how banks make money. The problem is that a lot of these investments were now underwater. You see, when you invest in a lot of the bonds that they invested in mortgage-backed securities. So a 3% mortgage equals a 2% coupon because everybody takes a piece. So those 2% coupons, I'm getting 2%. That's okay if I'm paying a half of 1%. I'm making money on it, okay? However, what starts to happen is as the Fed has maniacally raised rates without thinking about the consequences, they're not very good at unintended consequences, they now give people alternatives to move their money. So now you can move your money to a short-term 6-month treasury and get 5%. So people start withdrawing money. Tech companies were doing a little bit more poorly, as we know. They start having less capital. There's less money going in. So what happens is that the bank now has to make up this money. Where do they get it from? They have to now sell assets. Here's the real craziness of it. They had on their books $12 billion positive, but it really wasn't. Because once you started looking deep, what they had was invested in these bonds that were now underwater. Under Dodd-Frank, these are considered now to be no-risk assets. So you do not have to report under Dodd-Frank unrealized losses. They had $15 billion in unrealized losses. This was not a solvent bank. They were $3 billion unsolvent as at the end of last year, which is why the CEO was selling stock, which is why you had insiders getting paid bonuses upfront and early. Now, they start to get exposed because Jim Cramer, an amazing 5 weeks ago, touts this as the stock you got to buy. Okay, it is.
Stop it. Jim Cramer was out there doing his thing again.
Are you joking?
February, I swear to you.
Wait,
February.
no. Pull up the video.
We got the video.
Is this the same Jim Cramer that compared Sam Bankman-Fried to Rockefeller or to Andrew Carnegie?
There's actually an ETF, which is a contrary to Jim Cramer. But anyway, real on point here.
I'm sending it to you just so you know.
So Jim Cramer on February 8th talks about how the stock's undervalued, how it has room to run, is his quote. It was at $320.
Here's, watch this. Just
watch this.
Put the audio so we can hear it.
It's the Jim Cramer dead cat bounce.
Watch this.
Year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yeah, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls
just a few weeks ago.
like
February 8th,
last year,
5 weeks.
It takes it a lot more to recover After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it.
That's crazy.
I think it's also a good example of why these bounce-back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels.
That's crazy.
Tax law selling.
Yes, it's crazy. But Patrick,
We should find the chart on this.
But here's
this is a classic. This is SVB. It's a classic dead cat bounce.
But he's right. But here's why this is significant.
Yeah.
Because this draws attention to SVB. Now, whether you want to think of it as investment or not, now people start digging in. And as people dig in, what do they see? They see this $15 billion in unrealized losses that they didn't have to report. But now that you dig in, and what do they start telling their clients? They start telling your clients, hey, you know what? This bank is vulnerable. I'd probably take my money out of there. And as deposits start now cascading out of there, this is where they have to raise money. They go to raise $21 billion, and they do because they have to. But how do they do it? They sell some of their assets. Now, when you sell those $21 billion, they cherry-picked them. Only $2 billion in losses. But now you have to realize those losses, right? So when people look under the hood, they say there's another $13 billion in unrealized losses. People start pulling out money in droves. They can't borrow money. The shorts are attacking the stock. They can't issue stock. And this is how it happens so quickly.
So let me just give some of the stats. If you can have this here. 16th largest bank. 97% of the money at Silicon Valley Bank is not protected by FDIC. I've seen 93%. I've seen 97%. Whoever's right, one of the two. Either way, it's a lot of money. 12 days ago, like 13 days ago, the CEO, Gregory Becker, sold 11% of his shares. Daniel Beck, the CFO, sold 32% of his holdings. CMO Michelle Draper sold 28% of her holdings, around $5.1 million. If you post a picture of Forbes just 7 days ago.
This one right here.
By the way, they took the tweet down, just so you know. That's the one I posted, but they took it down. It just go to the picture I sent you. It's another one of those pictures I sent you, Rob. They should be on your phone. Go one more. Right there. Look at this. This is their tweet. This is 6 days ago. Proud to be on Forbes' annual ranking of America's best banks for the 5th straight year and to also have been named the publication inaugural Financial All-Stars list. They tweeted this. I retweeted this. They took it down because they obviously, I'm sure a lot of people were retweeting this. This was all over the place. They don't want people to see. Just 5 days ago, you're bragging about this. So this becomes the question. There's a terminology called front running, right? You know what front running is. If you can pull up the definition of front running, let's just read the exact definition. The practice by market makers of dealing on advanced information provided by their brokers and investment analysis before their clients have been given the information. Okay, this is if an investor does this. What's worst is when you're in it, you're the guy that knows what's about to happen and you do it. Isn't this a crime, Tom, to do something like this?
I'm on that page. I like to see an investigation. I'll tell you why. I am right here with Barry. By the way, great to see you today, guys.
See you, brother.
Is on March 1st, Becker was at an event in Los Angeles, and he said, we pride ourselves on being the best financial partner in the most challenging times. He said that, but he said that and then was heading to London where he was going to go get a Bank of the Year honor at this London deal on the 2nd. It gets better. He had already been told that there was a call coming from Moody's. Moody's had looked at a footnote that was in there. Because remember, they don't have to disclose everything in standard parlance in a quarterly earnings report, but they did footnote in the details page that they had the $15 billion. Moody's saw that and came back and said, hey, we have a question. If you were to look at this as a mark to market rather than a mark to maturity, where are you at here? Because our assessment is we're going to lower you 2 ratings levels, Pat. 2. And he said, what do we have to do? You have to clean this up. And part of the plan to clean it up, exactly as Barry just said, sell $20 billion of it, but technically that's depositor money. That was depositor money you put in the bonds. Now you have to sell the bonds you're short. And then you have to cover the hole, it's called. Well, how do you cover the hole? Tell you what, we'll call some of our favorite venture capitalists and we'll issue some stock. Even though they were already down from 725 to 325, down 400 points in the preceding 12 months. And they're going to dilute that kind of a down. And so they went out to dilute it. But now we all know what happened. the bank run started. General Atlantic, I think, was the VC that backed out on the $500 million.
They were getting advice. They were getting advice from Goldman Sachs, which was really bad advice the whole way down. And in fact, the management had changed. They became very, very smug. It used to be a great bank, but then they were like, they thought they were too good for themselves. They didn't try to endear themselves to any potential investors or venture capitalists. They were like, they were not friendly to the environment, so nobody wanted to invest with them.
But to Pat's point about front running, you freaking know that you have footnoted your earnings report, Pat. He knew he footnoted it, and he knew that Moody's was in the lobby saying, we got to talk, and we may take you down 2 ratings levels. And yet he did this. I'm with Pat. I think there should be a deeper investigation on this.
This term front running, I've never heard this term, but we've all heard the term insider trading. And I Googled front running versus insider trading, and it's actually the same thing. It says front running is similar to insider trading with the minor difference in this case that the broker works for the client's brokerage rather than inside the client's business. So it's a form of insider trading is what front runner is.
But this is even worse though. Like what Nancy Pelosi and her husband get, accused of is insider trading. What a lot of these Congress people, how are you worth $140 million on a $160,000 salary? Okay, that could be insider trading. Dude, you're on the inside. You know exactly what's going on. The level of audacity to go up there and collect it and then come back and say, hey, we got the bank of the year. Hey, guys, sell off because this is $13 billion. Let's do it quickly. Look what's happening. And then now it's leading into what we are today. And by the way, when you look at their backgrounds of what they did, just kind of want to give you a background of what they did. The CEO was a director at San Francisco Fed. The CFO was a former analyst at Freddie Mac. The chief administrative officer, which you guys were kind of putting up, he was a former CFO of Lehman Brothers. The chief risk officer led credit ratings in 2007. The chief legal officer was general counsel at Citibank in 2008. So to say they have a star-studded lineup of people with experience to make sure a company doesn't make the mistake that Lehman Brothers made or others made, they haven't. And they still did this. Barry, you see the list of all these names of people. Qualified, their background, director of San Francisco Fed, former analyst at Freddie Mac, former CFO of Lehman Brothers, led credit ratings in 2007, which is the chief risk officer, or former general counsel at Citibank in 2008. What are you thinking about them knowing if you had all this experience, couldn't you have prevented this from happening?
Yeah. See, here's a couple of things. So, number one, they did not have a chief risk officer from April 29th till January 4th. Tom, am I right on that?
That's exactly right. Eight consecutive months.
8 consecutive months. So they did not have a chief. Why did you not replace your chief risk officer? They did not. And by the way,
Laura Izurieta stepped down from her role as CRO in April of 22.
Yeah. So now you don't have a chief risk officer.
Can you pull that up?
But wait a second. What's happening at the same time? At the same time, your risk is increased dramatically because the Fed has now gone on a rampage raising rates until something breaks. And here something is breaking. So during that time, if you take a look from the 4.5 months from June 15th, the Fed raised rates 300 basis points. In a 7.5 month period, they raised it 375 basis points. And in the last year, they've raised 450 basis points. You need a chief risk officer to what this is a mismatch in duration. Short-term rates are going up, and my long-term investments are going down in value. I need a chief risk officer to deleverage that, not after they've gone up 450 basis points on the short end, but after maybe the first 75 basis points and after long-term rates start coming down. Start unlevering these things. Start putting hedges in place. This is what you're supposed to be doing to protect the assets of the bank.
Yeah, it's wild you're showing this year. Laura stepped down from her role as a CRO SVP Bank April 2022. What paper is this? What magazine is this? Forbes. And formally departed the company in October, according to an SVP proxy filing. The bank appointed a permanent. By the way, here's what's weird. If you run a broker-dealer, you can't run a broker-dealer without an OSJ, Office of Supervisory. You can't have it without a branch office manager or BOSs, depending on the size of it. How the hell is a company this size able to even operate with? Tom, that's very confusing to me, how somebody can operate without a CRO.
It is. And we came from insurance for people that are listening. And we had, Patrick had put, even though we were a FMO, very large nationwide FMO, Pat included in the management team a chief compliance officer, which he wasn't required to do, but all the carriers had that because we always wanted to be one step better and look one step cleaner. And in this case, by the way, supposedly, Pat, she didn't leave in October. That's just her last day of pay. She left in April, and then there was like this period of time where she got her salary and benefits, but she wasn't in the building.
So what is I wonder what the level of responsibility is to disclose this to investors and account holders to know we don't have a CRO in payroll right now. Is there any disclosure that you have to disclose and let them know? Do they have that kind of a responsibility, or you don't know the answer to that?
I'm not clear what the federal regulations would be. And if it was these folks, probably footnote number 82 along with the $15 billion.
So this takes me, if you were going to say something, because I got a bunch of other questions.
There's so many moving parts here, and every day we're learning more information. But from your guys' optics, is this fraud? Is this idiocy? Is this a lack of leadership? Clearly, these guys are all smart guys. They've been around the banking industry forever. What does this boil down to?
It's very hard to say. And without the benefit of knowing what happened behind closed doors, you can only assume things, right? But it sure doesn't seem like this was run correctly. You have to see these Fed rate hikes coming. You see the mismatch in duration. Mm-hmm. Somebody needed to step up and say, we have to make some adjustments or changes. While there might be short-term pain, we can't let this get out of control.
Gotcha. And let me ask you one more question, because you kind of threw it in there initially, and my antennas went up because you used the word that we all learned in 2008, MBS, mortgage-backed securities. You said that earlier, and I was like, holy shit, we're going there again.
No.
What's that?
These are performing loans. There was no problem with delinquencies. This is just an interest rate move. So if somebody's think about how many 3% mortgages there were, right? So the coupons that they fall into is a 2% coupon. In other words, a borrower pays 3%, but by the time the originator, servicer, securitizer, everybody, Fannie and Freddie makes a piece, there's 2% left in the coupon for an investor like us, right? Mm-hmm. Or if you're a bank and you put a lot of your assets in, they're getting a return of 2%. I think their average return was like 1.86. Let's call it 2% is what they're getting. So if they're getting 2% on that, think about this. You're receiving 2 on a long-dated maturity. That's the rate you're getting. But as the open market gets to 3 and 4 and 5 on the coupon, where it is now is at 5 on the coupon, who's going to buy your 2% coupon? They will if you discount it enough to make things balance out. So at a discount, they'll buy it. But meanwhile, that's the $15 billion that they had in losses. So it wasn't always $15 billion. As rates were going up, maybe it was $1 billion, maybe it was $2 billion. That's the time where you could put hedges, you could put puts, you can unlever some of that. That's what the chief risk officer should have been doing.
And they've been living for so long under ZIRP, right? Zero interest rate, policy. And to buy for a bank, think about it. On the balance sheet, they were holding it as marked to maturity. No bank can buy a bond and mark it to maturity because when they're using deposits, it's part of the deposits. By definition, the deposits in a real tough economic situation have to be liquid enough to be retrieved. So how do you buy a bond marked to maturity when let's say Barry and I have a bunch of real estate and we buy a bond marked to maturity, and you say, you guys were idiots, you got it at 2%. We're saying, we're just holding it to the end. We don't have to sell it. So we're only going to make 2%, but that's okay. It's just going to pay out, right? And then we're going to get the principal back. But if that was a situation where we needed it to be liquid, then we get screwed. And what was the screw? The screw was 20 billion sold, 1.8 billion loss. That was what they had to pay off to the buyer to get them to take it off their hands.
But the held to maturity was allowed legally to be done by the Dodd-Frank regulation, which says it does not come off of Tier 1 capital. So these are deemed to be held to maturity. In other words, okay, the market fluctuation we just talked about, guys, if theoretically you held it until it got paid off or till it matured, you get 100%. You get par value back. So there's no theoretical loss. But if you wanted to market, like you said, to the actual market value, there's a significant amount of loss in where it is. So what the Fed did by setting up this facility is they said, okay, we will lend against what you have. So what happens is they say, we'll take it based upon the par rate. We will not give you a haircut. But now you got to pay us. You got to pay us, 4 3/4, 5%. Today's rate. You're getting 2% back, but it's going to eat into your profit margin. The other thing, Patrick, you said before, which is very interesting, and obviously this is where we're going, is now at the present time, all deposits are insured, not just the 250. Think about a small regional bank that today has to pay, and they can't afford it that much, to pay that FDIC insurance on all their deposits. What that may do is that, guys, that may force a lot of concentration. These small banks help startup companies. They help you. They're your local bank, right? That's who you have the relationship. Yeah. I mean, it could be where we see it like a utility, where they're all just concentrated and run by the government.
So here becomes a question, which is kind of, Adam, I think what you were asking. Responsibility goes on who? If you think about this, the conversation we're having on the Spaces was, okay, whose fault is this? You know, because right now they're not calling it a bailout. They're calling it what?
It's just a backstop. And by the way, bondholders are probably screwed. Shareholders are probably screwed. We're protecting the people that deposited.
But it's not a bailout, you know. Right. He's not a snitch. You know, it's not a bailout.
It's a bailout. It's
a bailout. You can look what Yellen says here on page 3. Yellen says, no bailout for Silicon Valley Bank. We're not going to do that again. Treasury Secretary Yellen stated that the federal government will not provide a bailout to Silicon Valley Bank, but will work to meet the needs of depositors who stand to lose millions after the bank collapsed last week. Yellen signaled that government bailouts like those from 2008 financial crisis would not be considered, but the regulators would weigh a wide range of available options for protecting depositors who had more than FDIC amount of $250,000 in their accounts. Yellen tried to reassure Americans that Silicon Valley Bank collapse would not create a domino effect for other banks, and that the core problem Silicon Valley was rising interest rates rather than problems with the tech sector. Okay, so in a way, when you read this, they're saying it's not a bailout. Where does this money come from? Is this money, money that's coming that taxpayers are not going to be paying? What are they going to do? Just print it? Who pays the price for that?
So here's the, when you crash your car, Pat, and you have to tell your dad about it, and you're very careful about how you word what was going on when you wrecked. That's what's going on here. She's saying it's not a bailout, meaning we're not printing money and we are not taking money out of Treasury to pay for this. Therefore, it's not a bailout. That's what she's clinging to. And I think they're full of crap. Here's what they're taking this out of what's called, there's a $100 billion exchange stabilization fund. That's to stabilize on an emergency basis the markets. Wait a minute. Where did that $100 billion come from once upon a time? It came from Treasury once upon a time. It came from taxes once upon a time. So she's saying we're not going to make new printed money and new instant appropriations on the congressional budget. That's what she's saying. So this $100 million exchange stabilization fund, she's taking $25 billion out of it and putting it there along with this brand new other device, the BTFP, Bank Term Financing Program, where they can now pay the difference between FDIC and the deposit in the event of a bank failure. So guess what? Now a bank can be irresponsible and say, well, we're not going to get sued by the depositors because the federal government's going to back them up out of this thing, and it'll just be our shareholders and bondholders that get screwed. So
I agree with Tom 100%. I just want to point out a couple of things on Yellen. So Friday she said, the banking sector is resilient. That's almost like a Baghdad Bob comment, kind of like, there's nothing going on here, right?
Nothing to see here, guys.
Right.
Because we make sure it's resilient.
Yeah. Right. And
inflation's just transitory. Nothing
exactly.
to see here, guys.
So then what happens is on Sunday morning, she says there's no shot of a bailout. I guess somebody must have pulled her over on the side and said, hold on, Janet, this is much bigger than you ever imagined, because now people can't make payroll. That's what people were freaking out at. How am I going to make payroll if the money's no good, right? So, because you could have 2-3 million in payroll. It's not uncommon for a lot of these companies. So now, when we talk about bailout, what they are doing truly is a bailout, and here's why. If I have something that's worth $100 and I'm getting paid by the government $130, way above market, and they say, yeah, it's okay for me to pay you $130 because 10 years from now you'll get the $130 back, they're theoretically not taking a loss, but they're holding it to maturity and they get it back. That's why they're claiming it's not a bailout, but they're paying above market for it. So therefore, it is. There's no other way to look at it other than it is a bailout. They're paying above market for something should be worth.
Let me ask you guys, with this whole reassurance and calming, don't you think it's sort of important to define and explain what a bank run is? Because that's essentially what this comes down to, no? Like, you start to hear these terms, like it's a bank run. They're trying to avoid a bank run. And that's just what? The definition of a bank run.
There.
I think it's
bank runs happen.
two discussions.
Tom, let him read it. Go ahead.
Bank runs happen when customers panic and everyone tries to get their money out all at once. The author explains that what happened at Silicon Valley Bank, leading to the second biggest bank failure in U.S. history, is essentially what happened here.
Did you see the lines of people outside getting their money? Like, literally. Have you seen those clips or no?
First Republic.
Yes, I have. Yeah. Well, isn't it true that 90% plus of Silicon Valley Bank's assets were above the 250,000 FDIC insured, meaning it was all major money from tech startups, millions and millions of dollars in there. So isn't it sort of on the bank to diversify who it's getting its money from? I mean, I don't know how that.
No, it's not on the bank. No, it's not on the bank. No, this is not this. Okay, so if you look at this here, this is how I process this. Yeah. Rob, if you want to stop because you're distracting everybody, we're fine. We don't need to see the video. So if you think about this, here's what I want you to think about. So in a situation like this, Bill Ackman comes out and says what? It's not fair. This is not good. You should figure out a way to take care of the depositors and all this other stuff. And then David Sachs goes and agrees with them. And Vivek Ramaswamy, who was running for office, comes out and says, no, this is a bailout. What are we doing? And then, David calls him out as a fox. It's a very interesting back and forth between Sachs, Ackman, Vivek Ramaswamy, and a lot of other people, right? Okay.
All heavyweights.
No, it's fine. It's all heavyweights. But now here becomes the thing to be thinking about. So when Benghazi happened, do you remember when Benghazi happened? How many people were killed during Benghazi? How many lives was it?
4?
4 people, right? And if you're an average person, if you were a Democrat, you said what? So Barack Obama and Hillary Clinton did their best. I mean, what else do you expect them to do? They didn't do anything wrong. They tried so hard. They had sleepless nights trying to take care of this. If you were Republican, what did you say? Hillary Clinton, this is why she's this. She was sleeping. And she didn't even want her to get up and see what's going on. And that picture they posted with Hillary Clinton, Barack Obama, and all this stuff, that's just a picture for media they posted, right? Okay, great. And then the average person, 3, 6, 12 months later after the election debates were done, guess what? They're going to the next news cycle. Hey, what's the next thing? Okay. Yeah. And people forgot about Benghazi. Guess who's never forgot about Benghazi till today?
The 4 families.
The 4 families that lost somebody. Mm-hmm. Fathers, brothers, mothers, sisters, husbands, wives, and all this stuff that, in this case, you're never going to forget. So think about those 4 families. If you're related and one of those individuals was your son or your brother or your father, what do you think you're going to do the rest of your life? There may be vengeance in you. You may have a feeling of what? Revenge. Mm-hmm. You're never going to be the same. If your kid is going to say, I'm going to go to the military, your reaction is going to be more dramatic than an average person because you're experiencing that pain. Your hate towards a Hillary Clinton or a Barack Obama is going to be what? Higher than anybody else because it's your fault. It happened under your watch. Can you blame those 4 families? No, we can't blame those 4 families. However, let's bring it to the situation today. So, Silicon Valley Bank, they go through what they're going through. Fine. Who do you think cares about that bailout the most? People that have money with Silicon Valley Bank. Who else do you think cares the most? Those who have their employees that they're paying the salaries through Silicon Valley Bank. Who else? People who work for Silicon Valley Bank. They should care the most, okay? All right. Secondly, if you go to the people who criticize capitalism the most, which capitalists do they criticize? Those socialists or Democrats or low and middle income families that say capitalists, all they care about is what? Money and all this other stuff. Who do they criticize? This is exactly what they criticize. Because when you think about the foundation of capitalism, there's 4 things. The foundation of capitalism comes down to 4 things. Mm-hmm. It's freedom to buy. It's freedom to try. It's freedom to sell. And you know what the last one is? It's the freedom to fail. A lot of people at this level want the first 3 freedoms, but they don't want the 4th freedom. What's the 4th freedom? Dude, you failed is what you did. So what do you want to do? Well, we got to get our money and all this other stuff. Okay, fine. Now, some people say, well, you can't say that. If it was your money, you would also be saying the same thing to get the money. I'm not disputing that. You're right. If I had money in there, I would be very concerned because that's my family's money. And rightfully so, just like you, if you're 72 years old, you're probably less thinking about what it is to be a barrier of entry or regulation holding people back from competing with these super centers at Walmart or Target or a financial code. You're probably more thinking about what? Medicare, MedSup, retirement, Social Security. And you should, because that's what's affecting you directly, right? So I'm not judging the people that have money in Silicon Valley Bank, but it is a right criticism to say you want to be protected, but you go take all the risk. So what does this teach? So imagine in life how you create resentment for kids. I got 4 kids. If I discipline my oldest son more than in a different way than I discipline my youngest son, I officially create resentment between them two and from my oldest to me. If I discipline Tico for he does something and I take iPad away from him for 2 months, but the same thing Dylan does, and I let him play iPad for 2 months, Tico's going to say, I knew he was your favorite. I knew he was your favorite. And today, the low and middle income families, guess what they're saying? I knew they were your favorites, Fed. I knew they were your favorites. You bailed them out again. You gave them money again. They're right. Mm-hmm. You sit there and try to say the opposite argument.
But this does affect them, though, Patrick, because the payroll and then the contagion to other banks. I think the banking system, the shareholders who invest in the banks, they're not being taken care of. They're going to probably lose everything. The people who loan money or the bondholders, they're probably going to get a fraction of what they invested. Maybe. Scraps. I don't know. I don't know what it's going to be, right? Anybody's guess is good as mine.
Bonds are first position. They'll probably get scraps.
But then the depositors, that's the everyday person. It's their money, and if it wasn't them making
Silicon Valley Bank is not an everyday person's bank, though.
Correct. I know, but
this is not a community bank.
But if it would have been,
this is a regional bank. There's only 27 regional banks in America. They're one of 27.
But if you worked for them, you couldn't get paid because your payroll was in there.
Well, guess what happens there? Here's what I would say. What happens with there? There's a guy named Jamie Dimon. Okay, You know what Jamie Dimon did last Thursday with his bankers? Hey guys, call every single one. We're doing an all-nighter today. Call every single one of the accounts and businesses that are with Silicon Valley Bank. Tell them to come over here. Here's what we're going to do for you. We'll take care of you. We're going to make sure your employees get paid. We're going to do this. We're going to do that. Capitalism works its way out. Let me read you this note that the COO of Shopify sent out. Can you show the COO Shopify? If you can read it, I'm going to read this message to you right there. Check this out. Go back one, the other way. There you go. Zoom in. Hello, this is Kaz, Shopify COO. Reaching out. I know that we've already sent you an email. Your Shopify payments payout going out to SVB and asking you to change your account on file. Please do that. I'm reaching out to also offer something else. If your funds are locked up and you have trouble hitting payroll, please let me know. We'll immediately open up a balance account for you and fund it with the amount of money of your payroll so you can pay your people. Don't worry about signing anything now. We'll get lawyers to get paper things later. We won't charge you interest. We want to help you pay us back with no interest when you're. This is capitalism. So this is what I mean by a Jamie Dimon sees and says, okay, SVB Bank, you want to be irresponsible and reckless? You want to get an award and then come back? There is a reason why this morning, can you pull up the one with the I get an email this morning from Goldman, first thing in the morning. And I'm like, what's this email all about? That one right there, zoom in. Look at this. They rate banks, the GSIB. You have to know what GSIB stands for. GSIB stands for Global Systematic something here. Let me read.
Important banks?
Important banks. That's exactly what GSIB stands for.
It's a cousin to CFA or whatever.
Yeah, it's called Globally Systematically Important Banks. What a weak name, but that's what they call it. Go down a little bit so everybody can see it. So at the top, all the way at the top, meaning zoom in a little bit, and then we'll go from the top. There you go. Yeah, there you go. So the most stable bank, they have JP Morgan Chase in a league of their own.
By the way, what's empty above JP Morgan's? Why is that?
Meaning somebody hasn't reached a level of 3.5%, which is like the highest level, is what they're saying.
Nobody's an A+, guess is what
well, JP Morgan Chase is an A+. They just don't have anybody that has a perfect score.
Gotcha.
So JP Morgan Chase at the top, then it's B of A, Citigroup, HSBC, which HSBC bought the UK branch of Silicon Valley Bank. And then you have the next tiers, Bank of China, Barclays, BNP, Deutsche Bank, Goldman Sachs. And then the next one you have, Wells Fargo is on that list, by the way, all the way at the bottom. So think about that. Wells is not at the B of A level. Wells is not at the Chase level. Wells is not at the Citi level. A lot of times people think Wells is one of those. It's not. Morgan Stanley on a lower list, and then ING, you see some of these other guys, right?
You see Wells, by the way.
Go all the way down. They're all the way at the bottom. You'll see them all the way right there. So this kind of gets you to say, all right, we got to be careful.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.